You open the mail to find an IRS CP523 notice, and your mind jumps to the worst-case scenario, picturing your next paycheck being garnished or your bank account frozen by the end of the week. That fear is based on a misunderstanding of what this letter actually does. The CP523 is a notice of intent to terminate your installment agreement. At this moment, your payment plan is still technically active. The IRS gives you 30 days from the notice date to fix the problem, keeping your agreement active. Even if the plan terminates, the IRS cannot execute enforced collections, like bank levies, until 90 days after the original notice. You aren't facing an immediate freeze today. You have a rigid, statutory countdown. Understanding how much time you have allows you to shift from panic to executing the precise steps required to fix the account. The IRS manages millions of active payment plans using an automated computer system to flag compliance breaks. When a specific rule is violated, the system generates a default notice without an agent reviewing the case. To find the cause, check the first page of your notice. Right near the center, you will find a section labeled Reason for Default. This logic tree shows the 4 distinct paths that trigger a default. The computer flags your account if you miss a monthly payment, incur a new tax debt, fail to file a required tax return, or fail to provide requested financial data. Do not take the letter at face value. Log into your IRS online account dashboard and verify the agency's claim against your actual digital payment and filing history. If you recently mailed a physical check, remember that paper processing takes 1 to 3 weeks. Your payment may have simply crossed paths with the automated notice in the mail system. Diagnosing the exact failure point is the mandatory first step. The specific trigger listed on your notice dictates the exact legal pathway you must use to cure the account. If your notice was triggered by a simple missed or returned payment, you execute a rapid catch-up maneuver. You make the missing payment immediately to bring the balance current. If the trigger was an unfiled tax return, your first priority is submitting that specific return. The IRS system will not entertain a reinstatement request until your filing history is completely up to date. This checklist outlines the requirements for an automatic streamlined reinstatement. If your total balance is under $50,000 and you haven't defaulted on an agreement in the last 12 months, the system allows you to reactivate your plan without needing a human review. Keep in mind that when the agreement is reactivated, the IRS automatically assesses an $89 reinstatement fee to your balance. Swiftly curing these minor compliance gaps allows you to bypass human negotiation and leverage IRS automated systems to restore your account's protection. If you missed a payment because your rent or living costs increased, avoid emptying your savings to pay a tax bill you can no longer afford. Forcing an unaffordable payment guarantees another systemic default next month. Instead, you initiate a formal plan restructure. When your ability to pay drops, the IRS has distinct protocols designed to adjust your monthly obligations to match your actual income. You trigger this process by submitting Form 433F, the Collection Information Statement. Here, you document your current monthly income and subtract your allowable basic living expenses. Submitting this updated financial data forces the IRS to evaluate your current economic reality rather than holding you to promises made when your finances were stronger. Based on this formula, the IRS may lower your monthly payment, transition you to a partial payment installment agreement, or place in Currently Not Collectible status, which pauses your payments entirely. A formal restructure aligns your tax obligations with your actual monthly cash flow, ending the financial mismatch that triggers automated defaults. Occasionally, the IRS's automated systems fail. You may have a perfect payment and filing record, yet still receive a CP523 notice in error. In this scenario, you must act before the statutory 30-day deadline expires. If you miss this window, the system will execute the termination regardless of your actual compliance. You formally challenge the notice using the Collection Appeals Program. To do this, you file Form 9423, ensuring you select the checkbox for Termination of Installment Agreement. The appeal requires specificity. You must provide a documented solution within the form, such as a copy of the cleared check that proves you made the payment they claim is missing. Invoking a Collection Appeals Program hearing creates a legal barrier. While your appeal is active, the law strips the IRS of its power to execute bank levies or wage garnishments. It operates as a statutory emergency brake, halting the automated collection process so an independent appeals officer can review the facts of your case. Once you have executed your cure, whether by catching up on payments, filing missing returns, or winning your appeal, you need confirmation that the agency has reactivated the agreement. Wait 1 to 2 weeks, then log back into your IRS online account to verify that your status clearly shows your installment agreement is active. This active status means the 90-day enforcement window is officially closed, and your wages and bank accounts are no longer at risk of levy. To prevent future errors, consider converting your reinstated agreement to an automated direct debit system. This ensures the correct amount is drawn on the required date every month without manual input. From this point forward, you must file all future tax returns on time and pay any new tax balances in full. Consistent compliance is the required maintenance to keep your payment plan active. Curing a CP523 notice restores your account to good standing and reactivates the legal restrictions on IRS levies, providing a predictable path to pay off your